Welcome everyone to our AirMiners investor panel event, first investor panel event we've held so far. My name is Jason Grillo. I'm the event director for AirMiners, and we have a fantastic panel of investors to talk through some of the most interesting aspects of venture capital, but also different kinds of capital and resources available to carbon removal entrepreneurs and business people, technologists in our space. Tito Jankowski's online. Hey, Tito. Tito, you're still muted.
Hey, everybody.
Hey. As will you all be muted when you first enter. I'd recommend that you remain muted unless for the remainder. If you have questions or want to field a comment, please use the Zoom chat function. Tito and I will be monitoring that throughout. So we will have that option for receiving feedback. Also, to let you know, this is being recorded and will be posted onto the AirMiners YouTube channel afterwards, so that if you have to duck out or that you can catch all the insights that we'll be generating throughout. With that, just note that this is going to be the first of other investor events that we aim to have in the future. So hang on to your hats. This is going to be a really interesting conversation with more for future AirMiners events. Oh, finally, too, thank you to everybody who has paid for a ticket today. Due to your voluntary contribution, we are happy to announce that we will be making this event a carbon negative event. So we will have removed more carbon than we started with. Yay. Yay to everyone. And with that, I'm going to introduce Daniel Matros from Creo, who is going to be our moderator for the event. And Dan, you can introduce the rest of the panelists.
Great. Thank you, Jason. It is my great pleasure to be here. I've been tracking AirMiners since it was its infancy as a web page with a list of crazy ideas. So happy to see the evolution and happy to join this first investor panel. And Jason, you've made one mistake. I am not an investor. My name's Dan Matros. I am Global Head of Research for the Creo Syndicate, which is a network of family offices with a mission to galvanize capital into energy and environmental solutions. And we've been talking about carbon removal, direct air capture since about 2017 in that network in a pretty formal way, but I do not write checks. So my insights on investing will be limited. And I will also note that I am pretty circumspect on all technologies related to direct air capture and carbon removal. So I hope to be a check on that. I'm enthusiastic about great ideas, and I want to see capital flowing into the space, but I myself remain circumspect. So with that, I will introduce our panel. We've got Katie Goyce, who's Director of Programs at Greentown Labs. Katie, waving right there, she's a proud Midwesterner, as am I. She's ex-Schneider Electric, and I really admire what Greentown Labs is doing. We've got Sierra Peterson. She is a partner at Lionheart Ventures. She'll tell you all about Lionheart Ventures when we get her going. She's got a degree from Stanford. She's an ex-rower. She worked at IEA, at the White House, and a bunch of PE-backed businesses. A pretty impressive set of experiences there. And then we've got Dan Fitzgerald, who's a long-time investor, been in various roles, and he's also on the board of Sustainable Surf. So he's a surfer, and just before everyone came on, we were talking a little bit about surfing, which I, as a proud Midwesterner, know very little about. But some of our panelists were talking about good surf breaks in Australia. And talking about Australia, that's where Dan Fitzgerald is right now, where it's 5 in the morning. So it's bright and early out on the front side of the world. And with that, I thought I would start a bit of get the conversation going. I'm going to start out with Katie. And Greentown Labs is a very well-established accelerator. And you've just launched a new carbon to value initiative. Tell us about what Greentown Labs does, and tell us more about the initiative, why you're starting it, and what do you think it might do for this field?
Absolutely. Super excited to be here today. Thank you for having me. I'm also a big fan of AirMiners and all you guys are doing to galvanize this space. I'm also not an investor, just like Dan. We have that in common as well as being Midwesterners. But what I do at Greentown is oversee our partnership accelerator program. So Greentown Labs is the largest clean tech or climate tech startup incubator in the United States. We offer both physical resources and partnership resources to climate tech companies. And Carbon to Value is a new initiative that we're launching. It is actually not a Greentown specific initiative, but something that's being done in partnership with our partners at Urban Future Labs and Fraunhofer. So we've done work with these partners in the past, most recently our H2 Refuel program in 2019, which was sponsored by Shell and Toyota. So we're really excited to work with them again. And why we're doing this is, I think, similar to why everybody's here today. We know that carbon tech is going to be hugely important, not only for addressing climate change, but it's also going to be a $1 trillion market, and we want to make that happen. And we think that a critical piece of making that happen is corporate partnerships. Corporate partnerships can be really helpful for climate tech startups. We're going to hear a lot of today about climate tech startups and carbon tech startups in particular raising capital. And it can sometimes be hard for hardware companies in this space with a lot of technology risk to raise that traditional capital. So corporate partnerships can be a great complement to that. There's also a lot of B2B dynamics in our space. And so working with a corporate that can help you break into that market can also be really helpful. And then finally, a lot of this comes down to supply chain dynamics and figuring out how to make carbon tech take off and be sustainable as its own industry is going to involve changing behavior of multiple corporates at the same time. So whether a partnership between a startup and a corporate looks like a CVC investment or a licensing deal that gets the tech to market, or a pilot that shows other investors that the tech is investable, all of those things can be really helpful for helping startups get traction in parallel to raising money. And making those partnerships happen is what Greentown and our partners specialize in. So this Carbon to Value program is really that dynamic on steroids. We know that the carbon tech ecosystem is really nascent. There's a lot of wonderful energy, and AirMiners is a great example of that. And so what we want to do is provide a platform specifically where startups and corporates can get together and look for those end markets of those really nascent technologies that are maybe still developing. We know that being able to customize that technology for a specific end use, whether it's building materials or plastics or fuels, might take some back and forth with the corporate partners at the other end of the market. So we want to provide that platform where these folks can come together and share that information to really get that market signal going. So we just announced the program in July. Our RFP for startup applications is going to come out in October. It's a multi-year initiative. We're going to have a lot of corporates on board, so a lot of different industry verticals will be represented. And I'm really excited to share more about that when we get the RFP together.
All right, okay. So we're going to switch over to venture capital now, and I'm going to bounce it over to Sierra, who I will start by saying that venture capital, with a few notable examples, the activity around venture capital has been muted in this space. There's a lot of talk, but there's actually not that many venture capitalists investing in the space, and especially around direct air capture. Sarah, can you tell us a little bit about how venture capital works, what venture capitalists are looking for, and tell how well it might fit or not fit with direct air capture and carbon to value type companies.
Sure, happy to. So my name is Sierra Peterson, as Dan mentioned, and for a little context, I am an investing partner at Lionheart Ventures. We're an early fund that invests at the very early stages of other companies' life cycles. Seed, pre-seed, sometimes first check-in, across the climate protection spectrum. As Dan mentioned, I bring about a decade of experience in building venture and PE-backed companies, and so have worked both as a policymaker in designing markets, as an operator in building companies, and now as an investor, always trying to address climate protection. Really spent my entire career in thinking through how do we address climate crisis at scale. And I think specific to your question on, or your observation that VC activity in direct air capture and carbon removal has been muted, I would say it's an overstatement. It's actually, I think, very small amount of capital flowing in right now from traditional venture sources. I think it's a function of a few things. One, as a positive, there are better sources of capital generally available and resources. Catherine spoke to, obviously the enormous resources that Greentown Labs and others are bringing to the space that don't require dilution of one's cap table, one. And then two, of the difficulty that many traditional venture investors have in recognizing a venture trajectory from some of these early stage technologies. So I know I shared the rather tongue-in-cheek deck that I hope folks had a chance to look at as a pre-reading slides. And if you didn't, that's fine. We can run through the fundamentals. If you did, happy to answer specific questions on that. But the punchline on that particular trajectory, and it's written by an early stage investor who's backed companies like Blue Bottle and Uber and others, is when you think about the incentive structure for a venture capital like us, a venture capital firm like us, you are effectively signing on to create a $3 billion company in under 10 years, ideally 6. And that's a tall order when you have technical risk and scale-up risk, and you have significant market uncertainty regarding some of the offtake for these very promising technologies. In many cases, the markets themselves have not caught up with the negative externality of carbon pollution. We recognize it. We all know it's there. The science is pretty clear, but it has not yet been priced into either corporate decision-making or, in many cases, into public policy. And so many VCs are just unwilling to take that bet. I think that's a very fair statement, and one of the reasons why we haven't seen more activity in this space yet. That said, there are opportunities for investment, and we as Lionheart have made 2 investments so far in carbon removal technologies. One we've announced, Opus 12, is a company that's in the utilization space for carbon dioxide as a feedstock for specialty chemical production, and one we have not yet announced. It's very recent, but it is another that we are excited about. And the way that we got comfortable with both of those and excited about what they are building is that they have identified high-value niche markets in which to sell initially and scale up. And what this means is on their way to $100 million, $500 million in revenue, those are the sort of multiples you need to think about when you think about a $3 billion exit. They are able to bring in non-dilutive capital that reduces the overall cost of scale. And it enables them as founders to maintain more control over the cap tables. It enables us as early investors not to get completely diluted down so that our very, very small slice at the beginning is worth very little in 5, 8, 10 years when the company is, exits at its full value. So I'm happy to give more color on any aspect of that trajectory, and also to answer specific questions about the slides that we share. I don't think I can do a better job than the cartoon structure of what those slides describe in terms of the journey of a typical VC and a fundraising journey. But it's, oh, can we share the slides here? I think Tito just did, and we'll send it again. It is a tall order, and it's one that can create a lot of stress for business models that have a lot of value, but that may not be on the precise commercialization timeline or trajectory of what venture requires to make sense for everybody. So I know Dan's going to speak a bit about where venture fits in the overall funding ecosystem as well. And I think it's really important as a founder to recognize that VC capital can be essential. We can help you create markets. We can do a lot for you. But we should also perhaps be the last stop on where you look for financing, because we are so expensive. And there really are, in some ways, better sources of capital that are better suited for specific stages and scale up, especially at the early stage.
Great. Let me bring Dan F. into the conversation. So I actually characterize venture capital like the rest of the world of finance as this kind of weird corner of private equity that it just operates strangely. But there's all sorts of other types of capital. And I think one of the leading edges right now in thinking about carbon removal, direct air capture, is how to think about these other types of capital. This includes, growth equity, real asset, project finances, family offices. So Dan F., what are these other types of actors in the capital stack, which maybe can bring bigger checks, maybe less expensive type of capital than the venture capital that Sierra was talking about? What are they looking for? How do they fit in? And do you think that capital is ever going to flow into carbon removal businesses?
Good morning or afternoon, everyone. It's nice to be with you. Thanks for giving me the easy questions, Dan. I did notice a bunch of familiar names on the line, and feel very privileged to be sharing the space with you all. From my perspective, I think there's an ecosystem building around these themes, and the way that I guess we've characterized what we are doing is investing in regenerative technologies, which I guess in our definition are going beyond sustainable, ceasing to do harm, and actively healing the environment, and in doing so, people's lives. And so for us, that's a very broad thematic, and carbon removal is a big part of that. And I think it can take various forms, both direct and indirect. And I think people are really leaning into the space and looking for signaling from people like Sierra and other early stage funds, and the incredible programs that are coming, things like Cyclotron Road, as another example, and Greentown that Katie's talking about. And I think there's capital there and sort of dipping its toe in the water. And I do think there are models that make a lot of sense for some of these, really large pools of capital at the later stage, whether it be, in the real asset space particularly. I think some of these business models are going to have annuity type income streams down the track, and are going to be very attractive to a low cost of capital, whether that be, pension money or, large family offices that you talked about, Dan. And so I think there's kind of we're really super excited to, put together a whole capital stack ecosystem. And I think that, to Sierra's point, venture's one tool on a tool belt, but we need to have all the tools, on hand, so that as a founder, you can come and be saying look, this is what my business model is doing, and here's the impact that it's having on the world. And sure, it might not be a venture type business, but where are the other pools of capital for me to engage with? And so I think that that's sort of really emerging, in real time. I don't know that that's fully developed yet, but I think that there's certainly, enough interest and enough collaboration going on in the space. I think it's very different to traditional, private equity or venture type models where, we're very happy to share research because everyone is, figuring out as we're going. And Sierra mentioned a company that, I've spent a lot of time with and have much admiration for as well. And through that process, like the kind of quality of technologists and scientists that we're able to access in the due diligence process is phenomenal. And actually, I just also wanted to mention the Circular Carbon Network is a great resource as well. That's been emerging and putting together this capital stack. So maybe I'll leave it there, Dan.
Nick is on the line and giving you a big thumbs up.
Thank you.
Yeah, Nick.
Thanks. I think I want to pick up on a thread you mentioned there at the very end, and how one of the companies you were working with, you got to meet a bunch of great engineers. Sierra and then Katie, I was listening yesterday to a different investor panel on a totally different subject. But Matt Norden from Prime Impact Fund, whom I'm guessing you guys know and love, was saying, like, part of his job as a venture capitalist is a talent scout. He could even say that he even said he would drop anything, anytime, if he found a special talent, regardless of what his investment thesis might have been. Is that true? And what do you look for in talent? I'll start with you, Sierra, and then I'd love to hear your thoughts too, Katie.
Yeah, I think that's absolutely true. I mean, yeah, like I said, if you team up with a VC, we are going to be your biggest champion. When I send a note to a founder saying we would love to make an investment, I say, here's the investment amount and here's my phone number, and text me anytime. I'm here for you to help you solve your problems. I'm here for you with recruiting. I'm here for you for whatever comes up, because we are now in this together for the next 10 years. To your point about what we look for teams that have the capacity to create defensible value. And that's both as engineers and scientists in a novel approach to solving some aspect of the climate crisis. It is also, though, being able to commercialize that at scale. So how are you going to take this innovation and sell it for $500 million every year in recurring revenue, or something that has that scale of value? And that can be found within fantastic founders. More often, though, it is found within fantastic founding teams. And so we look for people and teams who have both the vision and the patience and the resilience to create true innovation in a lab, and then to be able to navigate it through the inertia of existing industry to create their own industries and their own multi-$100 million revenue streams. I think a great example of this is the team at Opus 12, where three co-founders, two of whom superlative scientists, the third an MBA. The three of them met at Stanford, and they have been able to really work together as a super cohesive team.
Katie?
Yeah, so to echo everything Sierra said, and a couple things to add on to that, like when I'm looking at a company for one of our programs, like what really jumps out to me. On the one hand, having an experienced serial entrepreneur on your team, especially somebody who's been through really great exits and then maybe some failures, that indicates that there's a learning process there. And so that can be a really great sign. I think balance across the team is really important. We've worked with companies led by CEOs who recognized that they really didn't want to be CEOs and actually wanted to be CTOs instead. And that self-awareness is awesome. I think it's really important. There's nothing wrong with that. It's important to recognize that and look to actively create a well-rounded team. And that kind of leads into the third thing that I would say. I was talking with Dip Patel from Saluna about a month or two ago for one of our speaker series at Greentown, and he was sharing with me that when he thinks about building a team, he's looking for people who are off cycle to him. And what that means is that when he's up, he wants somebody who's down, and vice versa, so that even your kind of emotional balance as a group is diversified. And so you want to think about diversification on all those different elements. So that's how we would think about kind of what looks like a really great team.
Okay, now I'm going to ask you the question, and I know you're on record, so you can handle this diplomatically. Can you give an example of a team where you'd say, they need something else? They've got a gap that they need to fill. And what advice would you give people who are very self-aware in their company building and say, hey, we're missing something here?
Absolutely. I think the self-awareness is huge, and there's nothing wrong with having a gap if you recognize it. I think that example of the CEO who recognized that he wanted to be a CTO is a great one. We've also worked with founders who were relatively young and recognized that they needed to bring on someone who had a lot of industry cred to kind of round them out. So if you can vocalize it and share that with your mentors and your network, there's nothing wrong in knowing that you have a gap. Maybe there's something wrong in having a gap and not knowing it, but if you can identify it and vocalize it, that's part of the process, and that's a really great skill to have.
And one of the ways that we try and identify that through our diligence process is by asking teams how they handle conflict, because it's, sometimes founders will not respond particularly thoughtfully to what are your shortcomings. I mean, everyone's gotten that interview question like 15 times over the course of their lives. But when you can ask, how as a team do you work out differences of opinion, you can start to identify, this is an area that this team is totally not thoughtful about and has a real gap in their self-awareness in. And being able to identify blind spots as investors, it's not necessarily a bad thing, one, if a team is thoughtful about filling those, and two, if we can help. That's one of the things that we really try and think about, prior to making an investment is, let's say this company is amazing and the trajectory is obvious, like how are we going to add value? Because we're on the team too. The minute we write the check, it's like, okay, we really are in this together for the next 10 years. How can we help with these specific aspects of building a team and building the product and building the market?
Yes, and I will add, it is, I will not go so far to ask you, Sierra, but I'm aware of other venture capitalists who use personality tests as part of their diligence process. So it's one of those things you never think about when you're trying to get venture capital. You talk about the terms of the deal, but before the term sheet, all of a sudden you're taking a personality test as CEO. And I think that comes as a surprise to many entrepreneurs. It can happen out there.
Go ahead.
Please comment.
I was just going to say it certainly can. And I think it's, among other things, we as potential investors are trying to judge resilience. To Katie's point earlier, we try and look for teams that have that sense of stability and forward momentum as a blend and as a group, because there are going to be things that are really hard to get through. You don't know what they're going to be. Sometimes regulation might change. You might have a very well-funded competitor. It's just disasters happen all the time. And you have to try and judge during a diligence process, like, how is this team going to respond? So we don't send out personality tests, but we really do. We certainly ask, how do you handle conflict as a team? And then we also try and do informal back channel on all of our founders to get the true war stories from people they've worked with and people they've handled conflict with and been through the wars with, to judge how will they handle when things go really off the rails, because they're going to. Like, we know that. We just don't know what it is.
Excellent.
Dan, do you mind if I make a comment?
Please.
This is something we've been thinking a lot about and working with an incredible collective leadership, team building expert. And I really feel passionate about like leaning into these conversations. And so in building our firm, we're very much focused on getting that balance right and putting ourselves through some of these different tools. Oftentimes they're confirmatory to natural intuition, but it does give you a foundation to, I guess, identify and be self-aware around areas where, individually we might have some gaps, but as a collective, you can put together a team that rounds each other out. And so we're working with teams through that and through the diligence process, and it's not judgment around individual personalities. It's actually, I think, a value contribution to a team to be able to identify and say, like, look, here are areas where, in different situations, we might be too similar, and so we might have conflict because, 3 of us have a very similar personality and one doesn't, as opposed to having a more well-rounded approach where we're actually saying, like, look, we actually really complement each other. And my venture partner and I, we actually put ourselves together. We couldn't be more opposite on some of these things, but together it actually works out very as a perfect balance and a harmonious team. So I think it's really a signal too on the intention of founding teams to want to get to a good outcome. And that can be both an economic outcome, but I think, the mission behind what people are building here is beyond the economic outcome. And in order to deliver that, that takes extreme self-awareness and, the ability to look at yourself, and, openly and honestly, and work together to get to that outcome and kind of, bury the individual in that process and focus on the collective. And someone from CEV just commented, they probably know who I'm talking about.
Dan F., I'm going to pick up with you in a minute. But before I do that, I want to say that we're going to be moving to audience Q&A in just a few minutes. And I'll give everyone a reminder to send some questions to the group chat. I think Jason and Tito are gonna help feed those to me. So use the chat function to get your questions for this awesome panel out to us. So Dan, if I can pick up on kind of expanding this out towards businesses choosing partners and making it more specific to the carbon capture space. Katie brought it up before, kind of partnerships with big corporates and especially oil and gas in this space. I mean, when you look at the types of investors who have put money into direct air capture and carbon removal writ large, it comes down to rich guys and oil companies for the most part. There's some growth equity going in there now, but leaving the rich guys, and they're all men, aside, let's talk about the oil companies. We've got Oxy's partnered with Carbon Engineering, ExxonMobil's partnered with Global Thermostat. If you look at the corporate venture capitalists, I can point to a dozen different corporate venture teams putting money into a dozen different places in the space. How do you think about for fledgling teams? Do you have advice for thinking through the partnerships with oil and gas and the resources that they bring in terms of what they can add to the larger team via partnership, and what do they solve for that maybe entrepreneurs can't necessarily solve for themselves, and how to deal with them?
It's a really good question, and it's something that I think personally is evolving for me in real time, and I think the skepticism or cynicism towards big oil companies and big corporates in general. I've certainly had over the course of my career, but I've seen in the last 12 months, maybe 18 months, the intention behind those pledges are real. And, people are turning up, and I think where it's heading, and the intention behind, both the capital flowing into the space and the support of, be it early stage science, early stage entrepreneurship, that's emerging, is incredibly valuable to where we're headed. And they're part of the ecosystem. And I think it's a really delicate, on an individual level, scenario to walk through. But I think, as an entrepreneur and a founder and a founding team, doing as much diligence on your investors as they're doing on you is like absolutely, core to the process. And I think having the balance sheets of, big oil companies or big corporates in general can be useful. It can also be to the detriment of some companies. So it's a very nuanced approach, I think. And I think that, to your point, the people who are funding these early stage innovations right now, tend to maybe form a certain archetype, maybe not as extreme that you outlined, Dan.
It's my job as moderator to
to be provocative,
to keep it interesting.
So yeah, like I take a holistic perspective. I think we need to build this entire ecosystem, and if people want to turn up with the right intentions and be, good players in the system, then that's great. I think, everyone that's on this line and the broader space in general talk to each other. So bad behavior doesn't kind of lend itself to longevity and supporting good initiatives and good companies. So yeah, it's a really tricky balance, I have to admit, but I think that it's certainly evolving, and I think the tendency is towards the more positive than the negative.
Great. I'm going to start diving in on some of the questions, and I'm going to bounce the first one to Sierra. This one came across chat. And how do you, as an investor, weigh CO2 savings and financial gain? They use an example. Questioner uses an example that says, how would you choose between a business that would make you 10 million and reduce emissions by 1 million tons, or make you 3 million but reduce emissions by 100 million tons?
Yeah, we don't choose. We have enough scarcity of investing dollars ourselves that we have to find the businesses that, make the 10 million and reduce the 100 million tons. I know it's a cop-out, but that's what our limited partners expect of us. We are not a concessionary financing. We are competing for limited partner capital alongside Sequoia, Andreessen Horowitz, you name it. Some of our LPs have invested in those funds as well. So we don't have the luxury of being able to choose one way or the other. We have to choose both.
I will add that there are other types of investors out there that I've come across that have put out archetypes like carbon return on investment, CROI. Which return on investment is a pretty standard calculation, a term that gets thrown around. And if you start looking up on the internet, you'll get into deep discussions about the right way to calculate ROI. But there's an analog around carbon ROI, which is the amount of emissions that you reduce per dollar, which may form as something you could look at in a quantitative way related to financial return. So that exists out there. There, I would say your investors are frontier type investors are the ones that are incorporating that into their analysis right now. I want to there's a question about Airco, which is making a high value chemical from CO2, i.e. premium vodka. I'm going to expand this question because this is one that I kind of have been thinking about around consumer demand. And I would say that a lot of these companies that are in the space are business to business type companies. They're not consumer oriented companies. But there is this increasing consumer awareness. So Airco is a direct-to-consumer company. I think Tito's making necklaces with negative. That's another consumer thing. But there aren't very many. It's not a space that necessarily lends itself right now to consumer-type businesses. And so the question is, and maybe Katie, I'll ask for your thoughts on this. There's consumer awareness is growing on this. Obviously, if Airco can sell vodka, which is really a brand game as much as anything, if they can sell it, it's an indicator of consumer demand. If Tito can go and sell necklaces, which again is kind of a lifestyle type of choice, it indicates consumer awareness. And I've picked this up pre-COVID at cocktail parties, where I run into high school students who are telling me all about carbon removal and how they want to get into direct air capture. So there's awareness out there, but I don't know if you can build a business on it. So what do you think you do with that consumer awareness?
Yeah, absolutely. And really excited that you're talking to high schoolers who are interested in working in this space. That's honestly super encouraging. So I do think that there is a growing awareness. At the same time, I think that strategically, you being an entrepreneur would want to look at that as a stepping stone to de-risk your tech and figure out what your ultimate scalable market's going to be. I don't know that that ultimately selling vodka is going to allow somebody to become a $10 million business. I do think that process could provide a certain amount of resources to de-risk the tech and figure out what that end market could be. So let me give an example of Gravity Labs. I remember hearing about Gravity years ago when they were pulling pollution out of the sky and turning it into ink. And I think there is a really cool mural in Hong Kong that was made out of this ink. Really cool story. And the narrative was obviously part of the brand and part of the value. If you look at them today, they are pursuing end markets in plastics and industrial inks and materials. And I see that as ultimately a much more scalable market than consumer ink. I think that connection point, that's actually exactly what we're trying to solve with carbon to value, because each different application is going to require different specifications, right? And so knowing that you have this material, and then what quality of it would you want to really hone in on and perfect for this ultimate end market? So whether the alcohol becomes some industrial chemical, getting that market knowledge and that customer discovery from a corporate that could ultimately help you access that enormous chemical market, that's exactly number one, what Carbon to Value Initiative is trying to solve for and provide a platform for and a structure for. And that's also the construct that I would encourage startups to think about consumer demand within. It's a stepping stone to a larger, bigger market, and it's a step along the way.
I have something to add there as well. I think, to your point, these direct-to-consumer may be somewhat niche, but selling to other businesses who can build a brand around high-quality negative emissions is certainly a growing industry. And we're seeing this, Stripe recently announced its negative emissions purchases, the cohort 1. Other companies, Shopify, others who have dabbled first in offsets backed by forestry, other projects, frequently nature-based solutions, and are recognizing some of the constraints in scale and quality on those initial crop of projects, number one. And then number two, general consumer skepticism regarding offsets to begin with, are turning towards truly defensible negative emissions to be able to back up their commitment to offset, the negative emissions, the one-for-one trade that they're representing as part of their brand narrative. So that's again, it's a niche market. I mean, we estimate that some of the corporate procurement for high quality negative emissions, maybe 20 million a year, but it's certainly one that's growing, and I think really does play into how you scale and capture consumer demand and consumer interest in buying higher quality offsets, higher quality negative emissions, rather than just saying, oh, okay, I'm going to sign up for an extra $10 on my United Airlines purchase, and like, who knows where it goes.
Great.
Dan, do you mind if I jump in there too? I think
please start talking.
I think what the most exciting thing for me is seeing carbon as an essential building block for essential goods. And so, vodka's maybe a bit of a niche, necklaces and jewelry, but we're seeing it infiltrate into the food system and also in materials. So, Sierra mentioned a company like Opus 12, they're making polymers out of CO2 that's been converted and it's kind of stripped down into its kind of core molecule building blocks. And then we're, seeing, I see David from Novo Nutrients is on the line, like you're seeing companies turn carbon dioxide into single cell proteins for food production, whether that be for animal feed or for human consumption ultimately, and air protein's another example of that. And the same on like the materials side, where maybe it's a less direct carbon removal platform, but through regenerative agriculture, you're seeing biofibers coming to market. So a garment can actually be carbon negative as well. And so to me, it is actually like you getting this kind of awareness at the consumer interface that's rapidly shifting. And I forget the initiative off the top of my head, but this almost carbon labeling, both on food and on materials now, is sort of coming to light as well. So we kind of have the tools now to kind of shine a light on the traceability and the trust of the whole supply chain, and you kind of can see what you're getting at the end product. And I think that empowers consumers to make these choices. And I think that's really exciting as to, where that can lead.
Very good. All right. There's been multiple votes for Nick's question on the chat. I'm gonna read it. Nick and I have talked about this question a lot, but I want to hear the panelists' viewpoints. So the math on the amount of capital that needs to be invested to achieve the level of carbon removal required to address climate change is uncertain, but massively higher than is what is being deployed from everywhere, whether it's the pension funds, the family offices, the venture capitalists, government. Nick throws out 1 trillion tons over the next 80 years. So there's certainly some capital will increase as some of the early carbon removal businesses prove out, but there may not be enough time for that. So what do the panelists think are some possible scenarios to dramatically increase the flow of capital into this space in the next 3 to 5 years? Sarah, you've unmuted yourself, so you have the honor of tackling that one first.
Sure. I mean, listen, I'm going to speak off the cuff here, but if I were omnipotent, I would implement a carbon tax with a meaningful price on carbon, at least $100 a ton, and I think that would significantly shift some of the near-term decisions on fossil fuel subsidies, certainly, but also on investment in infrastructure. I think, Nick, I totally agree. I mean, we're a teeny little fund, and we're trying to de-risk in some ways the later investors who can write much bigger checks than we can by proving the point that these companies that we're investing in are both influential in drawing down potentially at scale, but also good business, and will 6x any VC fund. That's our particular role in this. I think too, one of the things that we look at and is, for companies that come and talk with us, is whether they have really thought through the full suite of policy incentives available at the early stage. And we've actually turned down companies that are promising, but really didn't do their homework on looking at 45Q, for example, or the low carbon fuel standard. Those are much bigger pools of capital than we as a tiny VC firm can muster, one. And two, they have the capacity for scale through direct interventionist policy, if there's enough political will, to shift things on a timeline that is more in line with the urgency. So not to bring everything back to public finance and public spending, but I think as urgency grows, that's a great lever to get things done. The market mechanism is one that is more likely to, at least from relative to small scale VC, shift and create an entire market of technologies.
Katie, Dan?
I'm happy to jump in. I would echo Sierra that I think government has a huge role to play, and I'm optimistic that hopefully we'll see some action on that front. I would also say that, bringing corporates into the game, and it doesn't have to be VC money from corporates, right? Like that's one potential outcome, but there's a lot of other value that corporates can bring to the conversation when there's a way for them to de-risk their engagement and their involvement in this. So whether it's licensing deals to get that technology into market, or a pilot that demonstrates to follow-on customers that your technology is safe, I think de-risking their involvement and figuring out how to get their financial assets, but also their market access and their industry access into the picture by showing them how much value this technology could bring to them is also going to be huge.
Yeah, maybe just building off of that. I think core to at least our investment thesis and, three hypotheses that, I ponder a lot and we're seeking to test is that we have this convergence right now of science, technology, and engineering that is making these types of solutions investable for both venture and other capital sources. We've got the demand side where you have, sustainably branded products growing 7x the rate of non-sustainably branded products and commanding a 40% price premium. So the market is voting. And then, this community, is this one data point in a bunch where the most talented people on the planet want to work on the most important challenges. And I think, consensus is like zeroing in that this is one of our biggest challenges. And so those things together, I think, create an incredible, weight of support and potential. And I don't know if people are familiar with Nassim Taleb's The Black Swan concept, but I think of the antithesis of that as like the rainbow swan. And like this is like, we don't know, and this is a total hypothesis, but I think that, things are aligning where this is possible.
But to Nick's question on how you massively increase capital, and I'll loop back to my question about oil and gas company engagement on this. I would posit one way of getting a lot of capital into the space, and I think 45Q sort of does this, is in the United States, you have a political bargain that's been made on 45Q to get basically enough congressional support to pass it, which is you've got something that helps both the oil and gas producers with their traditional business, but also helps potentially with carbon removal. Do we need more do we need more bargains like that to drive capital into the space? Dan, F, do you think?
It's a great question. And I think I'm a believer in the market forces driving the capital a little bit. Sierra's point around a price on carbon, I think, is like, the single biggest lever that we probably have to really accelerate. And I think the awareness of stranded assets and failing business models, I don't know the exact number, but the percentage of coal miners in North America that have gone bankrupt in the last 10 years is like near 90+%. So like you have these kind of incumbents on the way down. You have the dramatic S-curve on the other side of that. And I don't know exactly what happens when those things meet. But it's kind of exciting to be around the space as it's happening, and forward-thinking, C-suite leaders in those companies are on the front foot, and others are, attached to status quo and holding on. But I think there's enough kind of openness and engagement that is beginning to unlock those sources of capital. And I think when you have the 3 biggest companies in the world going carbon negative in the next 10 to 20 years, like that's a big deal. It's not like some, pink sheet listed company, in New York that's doing this. It's like the biggest companies on the planet. So, yeah, I think that's incredibly positive signals as well.
I'm also going to loop back on this idea of partners. And if we look at corporate balance sheets and where the most cash is right now, if you look at what corporations have the most money sitting in the bank on their balance sheet, I think it's almost all tech companies. And you've seen some engagement from tech companies, and maybe the Stripe announcement helped, perhaps made Microsoft think more about their commitment, which maybe made Amazon think about their commitment. But Katie or Sierra, are tech companies going to drive this? And if you've got a technology, should you be approaching a tech company to try and sell them on it?
Yeah, I'm happy to.
Oh, you go ahead.
Go for it, Sierra.
Cool. I think, frankly, I've been underwhelmed by the technology majors' commitment to actually doing something about the climate crisis. Amazon's $2 billion fund, that's fine, but they have a lot more resources they could commit to this project and problem. Both in terms of making direct investments, but also in really decarbonizing their entire supply chains. And I recognize this is on the record. That said, I think, one of the things that we look for in making an investment is, again, how have you as an early stage founder identified a recurring source of revenue that's going to enable you to continue to scale? How can you bring in revenue that will reduce the amount of capital that you need to raise, either debt or equity, to be able to build to the next stage, more plants, more capacity in getting where you need to go? If that's in selling high quality negative emissions to Stripe, great, that's a fine off-taker. If it's in partnering with Microsoft to sell negative emissions, also that's a fine off-taker. I think one of the things that we look at is in putting on our project finance hats. We're not a project financier at all. Obviously, we're equity investors, but understanding, following an equity investment and getting into the scale for a project finance team, Generate Capital, Ultra, somebody else, to look at asset level financing. They are going to underwrite these assets in part based on the strength of the off-taker. Much better, much more likely to have a lower cost of capital and have overall deal approval if you are selling your negative emissions to a very respected company like Microsoft than to anybody else. I think that's one of the things that we look at, and one of the roles that the corporate partners can play beyond their direct investment in either equity, debt, or in purchasing negative emissions.
Katie, you get the last word.
Oh, wow. Wow, what pressure. What I would add to that, I think that makes total sense. I think what I would add to that is I tend to think about it in two different categories of corporates, right, based on what their interest in the problem is. On the one hand, you've got folks who are mostly interested in it from a kind of offset perspective, who recognize that they have heavy footprints within their own businesses and they want to offset that. On the other hand, there are businesses that, regardless, they probably also have carbon-intensive supply chains, but they have an interest in the actual product that comes out of this. Maybe you make a chemical that you can, once you de-risk it, you can make it more cheaply and reliably than any other source. And that's the piece that seems most sustainable to me. And that's why I think creating this market signal and looking at the long-term commercialization options of the products that come out of this process is really, really exciting, because I think that's how we get to a $1 trillion market that propels itself.
Great. Well, I want to give a big thank you to our panelists, Sierra, Katie, and Dan F. Very much appreciate your insights. I'm going to hand it back over to Jason, because I think there's going to be a little bit of hangout time here afterward for everybody to talk rather than just the four of us. So Jason, back over to you.
Great. Thank you, Dan. And especially thank you, Katie, Sierra, and Dan F. Dan F gets the Gold Star for Early Riser Award, where it is now 6 a.m. in Australia. So kudos. And thank you too to Nicholas Eisenberger for introducing us to Dan Matras. For moderating today. I would also note that picking up on the 45Q discussion, our next AirMiners event is going to be a deep dive into 45Q that will happen in 2 weeks' time. So a good time to think about what 45Q means and how it can integrate into business models for carbon removal. So keep on the lookout. The note to join that will be, link to join that will be in the post-event email that'll go out. So thanks, everyone. And looking for you at future AirMiners events. Thanks to our panelists. Thanks to everyone who made today such a wonderful time.